In 2006, Nouriel Roubini predicted the housing bubble that would create the credit crunch globally. In 2010, he attends the Asian Financial Forum here in Hong Kong. And thanks indeed for joining us from New York. Now you're looking at another bubble. This bubble really is a question of looking at the US dollar, the way it's beginning to weaken, at the same time the strengthening of these various assets around the world. So my question to you is, when is this particular bubble going to be bursting?
In my view, these carry trades that are driving asset bubbles around the world because people borrow at zero rates in dollar, they go long in global assets. This can go on for a while because the Fed is on hold, is expected to maintain zero interest rates. The dollar is going to keep on weakening through most of next year. So this particular asset bubble, especially in emerging market, can go on for another 6 months to 12 months. The point I've made is, however, at some point the dollar cannot fall down to zero. We'll reach a point where essentially the dollar has fallen enough. At that point, there's going to be a risk that the dollar is going to appreciate. Once that risk occurs, then everybody is short in dollar and long in risky assets all over the world, in Asia, in Latin America, in emerging market, will have to close their short dollar position and dump their leveraged long position in these assets. And that could lead to a very drastic, dramatic snapback of the dollar and also a sharp correction of asset prices in Asia and in other emerging market economy. But it's not going to happen anytime soon. This bubble and this mother of all carry trades can go on for quite a while.
Well, Professor Roubini, let me pick that up, because really looking at the employment levels in the United States, those are actually, I believe, beginning to rise. At the same time, there are stocks, there are bonds all over the world rocking and rolling. So could it be that the bubble may be just about to burst much earlier than we think?
Well, the conditions in growth in the US are barely recovering. The job market is still very weak. We have an unemployment rate at 10%, including the discouraged workers and the partially employed workers. The unemployment rate is 17.5%. I expect that the unemployment rate is going to rise all the way to 10.5%, if not 11%. In addition to the job losses, there is also a fall in wages, a fall in hours worked, and therefore the negative effects on labor incomes are still significant.
Well, let's look at how you can correct this situation. You talked about interest rates before, but should the Fed begin to look at interest rates, begin, in fact, to tighten the interest rates?
I don't expect the Fed to tighten interest rates anytime soon. The recovery is going to be anemic and subpar. There are massive deflationary forces in the economy because growth is below potential, supply is above demand, there is an output gap that is still rising, there is slack not just in the goods market where firms don't have any pricing power, they have to cut the price of their goods to sell the inventory of unsold goods, but there is also a slack in the labor markets where workers don't have any wage bargaining power. If anything, they have to accept lower wages to essentially maintain their jobs. And this slack in goods and labor market implies deflation, implies weak recovery. We have a fragile housing market still, we have a fragile financial system, and therefore, in my view, the Fed is going to stay on hold at zero rate at least through the end of 2010. Possibly even into 2011. So there is no way in which the Fed can raise rates from this zero level effectively anytime soon, given there is going to be an anemic recovery with deflationary pressures.
Now, Professor Roubini, I understand that you think there's going to be a U-shaped recovery, but it was, I think, back at the end of 2008, you were talking about really total gloom and doom, that it wasn't going to get better at all. So what's the position that you see?
Well, my main view is there's going to be an anemic recovery of the global economy, but I also believe there is even a side collateral risk of a double dip. The risk of a double dip is relatively low, at maybe 20% probability, while I assign this anemic recovery 50 to 60% probability, but there is a risk of a double dip. And even with an anemic recovery, things are going to get worse. There'll be low growth, the slack in goods and labor market is going to increase, job losses are going to continue, real incomes are not going to grow very much, and therefore even a U-shaped recovery is going to be very painful for the US, for the Eurozone, for Japan, since I expect that especially in the advanced economies, the recovery is going to be very anemic.
Well, let's turn to this part of the world, in particular to China and the renminbi. Now, do you think that the Chinese government should really keep the renminbi under close rate at this time?
China decided to repeg the RMB to the US dollar about a year ago. That allowed some marginal slow appreciation of the RMB between the middle of 2005 and the middle of 2008, but with their exports plunging and their concern about jobs, growth, and social stability, they've repegged to the US dollar. And that's one of the main problems of the global economy, because as the dollar is falling, the Chinese currency is falling relative to everybody else with the dollar. There'll be political pressure from Europe, from Japan, to force the Chinese to appreciate the RMB. Even if they're going to do that in the next few months, I think that the amount of the appreciation is going to be very, very small and cosmetic. Think of it, in the best of all worlds, in 2004, 2007, and 2008, when China was growing 12% per year, where their exports were growing 30% annualized, and when their net exports were going to 10 or 12% of GDP, China was allowing an appreciation of the RMB of only 5 to 6 percentage points per year, a very, very small rate of crawl. Right now, growth is much slower, 8%, exports have fallen, the trade balance has shrunk. So even if and when China were to allow its currency to appreciate, it's going to allow it to appreciate by very small, maybe 2-3 percentage points per year, because they're worried about jobs, about exports, and about their own stability.
Well, let's look at the position rather more broadly from your perspective. And it certainly looks as if there's a certain amount of foreboding for 2010, 2011. It doesn't look good, does it?
I do expect that the world economy, especially the advanced economy, is going to have a weak economic growth for a number of factors. There is the weakness of the labor market, first of all. Secondly, you have these shopped out consumers that are saving less and debt burden in the US, in UK, in Ireland, in Spain, in the Baltic, in Australia, New Zealand, in Dubai, in all these countries that had the housing bubble went bust. They have to save more to reduce leverage. They're not going to consume very much. And consumption in the US is 70% of GDP. Therefore, growth is going to be anemic. And final observation on why the growth globally is going to be anemic: the overspending countries that were the consumer of first and last resort, spending more than their income and running current account deficit, like the US, UK, and others, are now spending less, consuming less, importing less. While the over-saving countries, the producers of first and last resort, were spending less than their income, running surpluses, like China, Germany, Japan, Asia, and Latin America, are essentially having a problem because they were not spending enough and they were saving. So if the overspendings retrench and spend less, and the oversavings do not compensate by reducing their savings rate and increasing their own aggregate demand, especially domestic consumption, then globally, where there is a glut of excess capacity and supply, the recovery of aggregate demand is going to be weaker than otherwise, because the overspending are retrenching and the oversavings are not overcompensating by spending more, and therefore the global economic recovery is going to be more anemic than otherwise, especially for the US, for the Eurozone, and for Japan.
Well, thanks for those answers. Now, you're attending the Asian Financial Forum here in Hong Kong in 2010. So what are your expectations, really looking at the forum, but also looking at the Asia-Pacific as well?
The Asia-Pacific region is one of the most dynamic regions of global economic growth. While I'm concerned about advanced economies, I am a more bullish view for China and for emerging markets, especially in Asia. And there is a lot of attention towards Asia because in the next few years, probably as long as reforms are continued, China and Asia's growth is going to be one of the most significant components of global economic growth. So it's crucial to go there to meet local officials, market participants, investors, and try to understand how resilient and how robust is the recovery of growth in China and the rest of Asia. So the future belongs to Asia in many ways.
Professor Roubini, thanks indeed for this interview, and he's attending the Asian Financial Forum in Hong Kong in 2010.